Hey everyone, my name is Alex Morgan, and today we're diving into one of the most intriguing questions circulating in the metals market right now. Is Warren Buffett quietly accumulating silver again? Now that might sound like a simple rumor at first, another internet theory, another speculative headline designed to grab attention. But when you dig into why this question is resurfacing now, in 2026, it becomes clear that it's less about Buffett himself and more about something much bigger happening you. And today we're going to break this down carefully, rationally, and with real market context. We'll examine what Buffett actually did in the past, what the current data says, what institutional money is doing, what supply and demand look like right now, how macroeconomic forces are shaping the silver trade, and most importantly, what could happen next and which direction silver may be heading. Because whether Buffett is buying or not, something unusual is happening in silver. And when unusual things happen in commodities markets, they often precede major moves. Let's start with history. Back in the late 1990s, Warren Buffett, through Berkshire Hathaway, made one of the most surprising commodity moves of his career. While he's famously skeptical of gold, calling it a non-productive asset that just sits there, he made a very different decision when it came to silver. Between 1997 and 1998, Berkshire Hathaway accumulated roughly 129 million ounces of physical silver. That was not a small speculative position. That was massive. At the time, it represented roughly 20 to 25% of annual global silver production. Markets noticed. Prices responded. Why did Buffett do it? It wasn't because he believed silver was magical. It wasn't a fear trade. It wasn't a panic hedge. It was a supply-demand imbalance trade. Buffett recognized that global silver consumption was exceeding production. Above-ground inventories were shrinking. Photography demand was still strong at the time, industrial usage was growing, and new supply wasn't coming online fast enough. He saw a classic commodity setup. Tightening inventories plus rising demand equals higher prices. And he was right. Silver rallied strongly in the years that followed. Eventually, Berkshire sold the position in the mid-2000s. Buffett later admitted he exited too early and could have made significantly more. Now fast forward to today. Is the setup similar? Let's examine the current silver environment in 2026. First, supply. Unlike gold, which is mostly mined for investment and jewelry purposes, silver is largely a byproduct metal. Nearly 70% of silver production comes as a secondary output from mining copper, zinc, and lead. That means silver supply is not directly responsive to silver prices. If silver doubles tomorrow, miners don't suddenly double production. They would need copper or zinc production to expand first. That structural characteristic makes silver supply relatively inelastic in the short term. Now here's where things get interesting. Global silver markets have recorded consecutive supply deficits in recent years. Annual consumption has exceeded mine production and recycling flows. That deficit has been filled by drawing down inventories, particularly exchange inventories like COMEX. In other words, physical silver is leaving vaults faster than it is being replenished. That dynamic is important, because commodities don't move based on headlines. They move when physical supply tightens. Now let's talk demand. Silver today is not the silver of the 1990s. Back then, photography consumed massive amounts of silver. Digital technology killed that demand. For a while, the silver thesis weakened, but a new demand driver emerged: electrification. Silver is the most electrically conductive metal on Earth. That makes it critical for solar panels, electric vehicles, semiconductors, 5G infrastructure, advanced electronics, and AI hardware systems. Solar panel manufacturing alone consumes enormous quantities of silver paste, and global solar deployment continues to accelerate due to decarbonization goals and government subsidies worldwide. Electric vehicles require significantly more silver than internal combustion vehicles. Charging infrastructure requires it, grid expansion requires it, artificial intelligence infrastructure, data centers, high-performance computing chips, require silver in connectors and circuit pathways. This is not speculative demand, this is industrial demand. And industrial demand is often sticky. So we have constrained supply and growing industrial demand. That already sounds familiar, doesn't it? It sounds exactly like the imbalance Buffett exploited decades ago. But here's where we need to be careful. There is currently no public filing, no SEC disclosure, no Berkshire Hathaway statement showing Buffett is buying silver again. If Berkshire were accumulating physical silver at scale, it would likely show up in regulatory filings or inventory disclosures eventually. Right now, we don't see that. So where is this narrative coming from? It's coming from price behavior. Silver has experienced significant upward volatility in recent years. Momentum traders have piled in. Retail investors are talking about it again. And when silver rallies, people remember that Buffett once made money on silver. So speculation begins. But whether Buffett is buying or not is almost secondary. The real question is, should he be? Let's look at macro conditions. Silver behaves as both an industrial metal and a monetary metal. That dual nature makes it uniquely volatile. When economic growth expectations rise, industrial demand expectations lift silver. When inflation fears rise, monetary demand lifts silver. When geopolitical instability rises, safe haven demand lifts silver. So silver has multiple catalysts. Right now, the global economy faces several macro uncertainties: elevated sovereign debt levels, persistent inflation concerns in some regions, geopolitical tensions in key trade corridors, and ongoing energy transitions. Real interest rates remain a key variable. When real rates rise sharply, precious metals often face pressure. When real rates fall or inflation expectations outpace rate hikes, silver tends to strengthen. If central banks pivot toward easing cycles, that could be bullish for silver. If industrial demand continues accelerating while supply remains constrained, that could be bullish for silver. If economic growth collapses severely, however, industrial demand could soften temporarily, and silver could correct. So where might prices go? There are several scenarios. One scenario is a controlled uptrend. Silver gradually reprices higher as deficits persist and industrial demand expands. Prices stabilize at a structurally higher range than historical averages. Another scenario is a speculative surge. Retail traders, ETFs, momentum funds, and algorithmic strategies amplify upside moves. Silver overshoots fundamentals. Then, a sharp correction follows. A third scenario is consolidation. The market digests recent gains, builds a base, and waits for the next macro catalyst. Now let's consider valuation relative to gold. The gold to silver ratio has historically fluctuated between roughly 40 and 80 over long cycles. When the ratio compresses, silver often outperforms gold. But Buffett is a value investor. He prefers cash-flowing businesses. If he wanted exposure to electrification or industrial growth, he might prefer owning mining equities, infrastructure companies, or energy firms rather than physical silver. That's consistent with his philosophy. So the absence of a silver position does not mean he doesn't see the dynamics. It simply means it may not fit Berkshire's framework right now. Let's zoom out even further. Commodities often move in long cycles. The 2000s were a commodity supercycle. Then we saw a long period of underinvestment in mining. ESG pressures limited capital spending. Exploration budgets shrank. Underinvestment leads to future supply constraints. Many analysts now argue we are in the early stages of another resource cycle, particularly tied to energy transition metals. Silver is part of that story. If that thesis holds, we could see multi-year support under prices. But here's the key risk: substitution. At higher prices, manufacturers may attempt to reduce silver loadings in solar panels or electronics. Technology adapts. However, silver's conductivity and durability make full substitution difficult. So we have a metal that is critical, constrained, and increasingly demanded. That sounds bullish. But markets are never one-directional. Speculative excess can create sharp volatility. Margin positioning can unwind. Dollar strength can pressure metals. Recession fears can dampen industrial projections. So directionally, silver's long-term outlook appears supported by structural fundamentals. But short-term volatility is likely to remain intense. Now let's directly answer the title question. Is Warren Buffett quietly accumulating silver again? There is no confirmed evidence that he is. But are the structural conditions similar to the ones that attracted him in the late 1990s? In many ways, yes. Supply deficits, inventory drawdowns, industrial demand growth, underinvestment in mining, macro uncertainty. Those ingredients are present. Whether Buffett personally acts on them is unknown, but institutional capital is certainly watching. And when large capital begins positioning in commodities, moves can accelerate quickly. If deficits persist through the next few years, silver could remain in an upward structural channel. If global electrification continues accelerating, demand may remain firm. If monetary policy shifts toward easing, that could add fuel. On the other hand, if global growth contracts sharply, or if industrial demand slows meaningfully, silver could retrace before resuming any longer trend. So the direction forward likely depends on three major drivers: industrial demand growth, real interest rate trajectory, and inventory trends. Watch those closely. Not rumors, not headlines, not speculation about secret accumulation. Markets ultimately move on fundamentals, and right now, silver fundamentals are tight. That doesn't guarantee straight-line gains, but it does mean volatility may remain elevated and the metal may stay in focus. Whether or not Buffett is involved, the bigger story is that silver is no longer just a forgotten precious metal. It sits at the intersection of energy transition, technology infrastructure, and macro uncertainty, and that makes it strategically important. So if you're analyzing silver, focus on supply reports, mining capex, solar deployment data, EV production numbers, COMEX inventory flows, and real yield movements. That's where the real signals are, not message boards, not unverified speculation. Now I want to hear from you. Do you think Buffett would ever return to silver? Or is this a new generation's metal driven by electrification rather than value investing? Drop your thoughts below. And if you found this deep dive helpful, make sure you subscribe to the channel. We break down markets with logic, structure, and real macro analysis, not hype. Thanks for watching, and I'll see you in the next one.